Good afternoon or good morning, depending on where you're joining us from today. Welcome to our webinar, Doing Business in Canada. Before we get started, I wanted to go over a couple of items so you know how to participate in today's webinar. So on the screen in front of you, you'll see an example of our attendee interface. There you go. So you should have something that looks like this in the upper right corner of your screen. Now, as we have a big group today, I do have everyone on mute. However, you can submit text questions throughout the entire presentation. You can do this by typing those in to that question pane that you see on your screen, indicated by the big red arrow. Your questions will be answered during the Q&A portion of today's session. I also wanted to let everyone know that CPD certificates, as well as the recording and the slides, will be provided by the end of the week. Leading today's webinar, we are thrilled to be joined by Michael Henry, Managing Partner of Hauser Henry & Siren. Michael is an innovative and entrepreneurial leader who thrives on working differently than most law firms to deliver a more client-focused experience. He helps Canadian and foreign business owners, as well as C-suite execs of mid-market private companies, tackle complex legal issues to grow and to manage risk successfully over the long term through a uniquely collaborative approach. Michael is specialized in M&A deals, reorganization, shareholder disputes and agreements, corporate financing, as well as commercial agreements and employment contracts, succession and estate planning. Michael also advises trust companies and trustees on estate administration. We are also pleased to be joined by Morris Wimmer, Senior Lawyer, Commercial Law and Real Estate Law with Spiegel Sommer, and Mark Wong, Business Lawyer, Corporate Commercial and Commercial Real Estate with Kaufman Califf. And now I'll hand things over to Michael to start the presentation.
Thank you, Sarah, and welcome everybody. We're delighted to be speaking to you today on doing business in Canada. I just want to review our agenda briefly. I'm going to introduce in a little more detail Morris and Mark, and we're delighted to have them joining us. Morris is in Montreal and Mark is in Vancouver, two very experienced business lawyers. I'm going to chat a little bit about an overview of Canada. I realize that many of you are in Canada presently listening in, but probably recently arrived to Canada, and I'll give an introduction about our legal landscape here. And then we'll talk about what does it mean to grow a business in Canada? What are the available structures, starting a business, and also we'll talk a bit about buying a business, an M&A, the M&A aspect. We'll talk about registering the business in Canada, some specific compliance, and then we'll entertain and welcome questions and provide our best answers. This is intended to be interactive, so please do feel free to submit questions, and we have time reserved at the end of the presentation to answer those. As Sarah mentioned, we're joined in Montreal by Morris Wimmer. I'd just like to introduce Morris in a bit more depth. Morris is a senior member of his firm Spiegel Sommer's Commercial Law Group. His practice focuses primarily on private mergers and acquisitions, working closely with entrepreneurs locally, nationally, as well as in connection with their cross-border requirements. Morris provides his clients with effective and strategic advice, finding legal solutions that make solid business sense. He's gained the confidence and status of a trusted advisor for many of his clients. Most of them have counted on his sound advice and service for over 3 decades. Welcome, Morris. I'm also delighted to introduce Mark Wong, who joins us on a panel from the West Coast in Vancouver. Mark is a business lawyer and partner with the firm of Kaufman Califf in Vancouver. He advises his entrepreneurial-based clients in commercial business matters. His experience includes acting for vendors and purchasers in mergers and acquisitions transactions, acting for vendors, purchasers, landlords and tenants in real estate transactions, advising on intellectual property and technology issues, advising on lending, borrowing, and leasing transactions, and generally providing a legal and business resource to the firm's business clientele. He's a member of the Vancouver and the Canadian Bar Association, the Law Society of British Columbia, the Vancouver Board of Trade, the Hong Kong Canada Business Association. Welcome, Mark. I'd like to just describe a little bit of the legal landscape in Canada. Some of you may already know this well, some of you may be learning it already. In Canada, of course, we have a federal system of government. That means we've got constitutionally, we have two levels of government, the federal government and the provincial government. And those levels of government have different responsibilities according to our constitution. We have 10 provinces and 3 northern territories, 2 official languages, French and English, and we also have 2 legal systems. In the English-speaking provinces, like Ontario and British Columbia, we have the common law as well as statute law, but common law is an evolution of the common law which has come from England. And in Quebec, there's a civil code, which Morris can talk to a little bit more, and the civil code is something that has come, of course, from France and continental Europe. When we think of business in Canada, we typically think of major centers such as Toronto and Vancouver, Montreal, and we're delighted to have lawyers from those cities speaking today. Canada remains a top destination for direct foreign investment and is full of great business opportunities, stable, friendly, advanced economy. I'd like to talk about available structures for businesses in Canada. And when I talk about this, I imagine in my mind being up north. I love to be outdoors and being beside a lake. And lakes can often be cold, even in the summertime. And there are 2 kinds of swimmers, I think, when it gets to a northern lake. There are those that want to put their toe in first and the others that want to just dive in directly. Sometimes there are good reasons for taking either approach. I'm going to start with the toe in the water, which relates to setting up a business structure, a simple business structure. Sometimes investment begins with a contract, could be a licensing agreement, a distribution agreement. Sometimes a foreign investor will be simply having an arrangement with a local agent to grow the business, and then ultimately the business can grow beyond that. Branch office is another very simple way to begin a business in Canada for a foreign business. Often it avoids creating a separate company. In Ontario, there would be a registration for an extra-provincial license, which is simply a permit basically for a foreign company to do business here. Most foreign companies require a license. There is an exception for American LLCs. In Ontario, they're treated as a partnership, so they don't require a license, they require a different filing. This structure allows the parent company to claim losses from the Canadian business, and the foreign parent would also have to pay Canadian income tax on income from that Canadian branch, and it would be subject to liabilities of the Canadian branch. There's also a Canadian branch tax which can be reduced by the branch reinvesting in the Canadian business. So the branch option is one of the simplest ways of entering the Canadian market for a foreign company. And the other possibility is to incorporate a company. And here, as I mentioned, we've got 2 levels of government, federal and provincial, and corporations can be incorporated at both levels. In this structure, the corporation has its separate identity, its separate existence, so its liabilities are its own, and they do not flow to, for example, a foreign parent. There is an exception for ULCs, which we'll talk about in a moment. To create a company, articles of incorporation are required. The articles indicate the name, the number of directors, share structure, and any restrictions on transfer. Usually in a private company, shares cannot be transferred without the consent of the directors or the shareholders. Sometimes a tripping point in creating a new company is choosing a name, and it's important to choose a name which is not currently used by a similar business, so there isn't any confusion in the marketplace. There's also a residency requirement for Canadian directors under our Ontario Business Corporations Act. 25% of the board must be resident Canadian directors. And that's sometimes an obstacle for companies that are, or businesses that are just starting in Canada. At this point, I'd like to invite Morris and Mark to talk about the incorporation in Quebec and also in British Columbia. Morris, do you want to chat a little bit about that?
Sure, thanks very much. So one of the advantages that we've seen in Quebec is particularly incorporation by foreign entities, or the use of a Quebec company by foreign entities to do business, to at least start business in Canada in the province of Quebec. And the reason for that is incorporation under our Quebec Companies Act provides for flexibility in terms of, most importantly, residency for directors. So in the province of Quebec, and it's been this way for many years, the board does not need to have a Quebec or Canadian resident director. You can put an American, you could put a European on the board without causing an issue with our legislation. In addition, the shares that are issued typically in the province of Quebec in a Quebec Companies Act entity can be issued whether those shares are paid for fully or not. And that's sort of a distinction as opposed to Canada Business Corporations Act entity, where I believe an entity incorporated under the other provinces of Canada. Mike touched upon one issue which we typically have in the province of Quebec, and that's the language problem. So, well, the language issue, let's say, not necessarily a problem. So the official language in the province of Quebec is French, and therefore an entity incorporating under our Quebec legislation requires a French name. Any entity doing business here in Quebec will require a French name. So that sometimes creates issues. The official corporate name would be in French, and then we would typically register a DBA or doing business as for the English equivalent. But that's something that people coming into our province need to be aware of. Mark? You want to address BC?
Oh, Mark, if you could take yourself off mute.
There we go. I'm just talking to myself here. Good morning, everyone. Welcome. We're truly giving you a coast-to-coast presentation today. It's surprisingly, there's many similarities across Canada in terms of Ontario and Quebec's corporate system. And then, of course, there's the differences because every level of government likes to do things their own way. So similarly, we have all the normal requirements to set up companies, articles. In BC, we're heavily electronically oriented. Our system has now progressed where we're actually able to create companies in probably an hour now. And it's been fully put in the hands of counsel and people who are authorized to be agents under our filing system. So we can, if you were to contact us and need a company, that can be done very quickly, provided you have all the information. And layered on top of this is, of course, which accountants are starting to understand now as well, is the know your client obligations of knowing who's behind the company, knowing the individuals, and going through those processes. In terms of dealing with names, in British Columbia, we haven't adopted what many of the jurisdictions have adopted, which is the nuance search, which is, it's a funny acronym, but I believe it stands for newly updated names. And that search is applicable across Canada. In BC, of course, we don't do that. And we do our own registry search. We search only our database. And so there's a potential for conflict sometimes if you have a national company that you're dealing with. And that's something to consider when you're proceeding with an incorporation. Similar to Quebec, BC dropped the requirements for director residency requirements, so it makes us a special target for potential foreign investment if you don't need to have resident directors on hand and part of the company. In addition, most times, by the time the structures come to us, as corporate lawyers often call it, the tax is usually wagging the dog. So many of your structures will have to depend on what your head office looks like, how you want to flow your funds. And one of those considerations is the ULC that Michael referred to. In British Columbia, we also have that structure available. And it's ULC is an unlimited liability corporation. It's a different sort of creature. And in fact, for US purposes, there's no checkbox under the US taxes for that type of entity, and so it's available to be used as a flow through out of the Canadian entity straight through to the US parent company. So that's been a really attractive basis for using that for some of the cross-border transactions. And other than that, the most reasons for separating as opposed to using a branch office is looking at the separate liability requirements. You may, depending on the type of the enterprise, and there may be a good reason to isolate any of the liability within that particular corporation.
Great, thank you both. The next structure I wanted to chat about briefly are partnerships. So this is a very old way of doing business. It's a structure that predates corporation, really, and involves any two people working together with a view to a profit in business. And there are two kinds of partnerships. There's a general partnership and a limited partnership. General partnership is this structure that's been with us for a long time, and in that, every partner is liable for the debts of the partnership. So each partner is jointly and severally liable, and that's sometimes an uncomfortable feeling. If it's individuals, of course, companies can be partners as well, but in a partnership relationship, that's a fundamental feature. Now, to address that, we also have something called limited partnerships. Limited partnerships have a general partner, one general partner, which is usually a single purpose company, a company that has no other assets, no other purpose, and it has unlimited liability. And that company is responsible for managing the business of the limited partnership. And then this structure also includes limited partners, and their interest is limited to their investment, and they're also required not to take a role in management. And if they do, there's a risk that they could lose that limited liability protection. We often see this used for real estate investments, but it can also be used for other kinds of ventures. And the partnerships are flow-through entities for tax purposes. Maurice or Mark, do you have anything to add about partnerships in British Columbia or Quebec?
Well, in British Columbia, they're very popular for using for real estate transactions, simply because the normal structure would be is you would set up a nominee company to be the title holder. The beneficial ownership would be owned by the partnership. That partnership would use their general partner to own the beneficial interests, but then you could have a number of investors in varying proportions all in behind that general partner that have their investment in. So it's a very flexible method of getting investment in and also allocating income and capital back.
Yeah, and I would say for the province of Quebec, we similarly see limited partnerships almost exclusively utilized for real estate transactions. General partnerships are typically used for professional entities, law firms, accounting firms, notarial firms. So that's really where we see it today.
So we have a question from one of the participants asking about how important is a shareholder agreement, which is, in this case has not yet been signed. Shareholders agreements are very common, and where there are two or more shareholders, parties often want to have something in writing about how they make decisions, how profits are distributed, what happens if there's a disagreement, what happens if one shareholder wants to leave or to sell or buy out the other. And they can be more complicated than that, but those are some critical issues to address. And I find in my experience that if a shareholders agreement is not signed at the time of incorporation when the company is created, then often it's put off and life gets busy. We all have priorities that take us in different directions. And sometimes 2, 3, 4 years later, the shareholders can still be talking about doing a shareholders agreement, but not actually having signed anything. So I would say that it's critically important to have a shareholders agreement, and it's something that should be done at the outset, even if that sometimes seems like it's an extra burden, but it's so much easier to do it before something difficult happens or some opportunity arises than after. Morris or Mark, do you have any comments you want to add on the importance of shareholders agreements?
Yeah, it's certainly one of the items I raise when I meet with the clients initially in terms of incorporation. I agree with you, Mike. If you don't deal with it in the early stages of the corporate existence, it sort of gets put on the back burner. I think it's important to sit down and get everybody's input as to expectations as to where, decision making, how the board is going to be comprised, whether there'll be a right of first refusal provided for in the agreement. And it's important to deal with those things when everybody is sort of excited about embarking on this corporate journey, as opposed to putting it on the back burner. One item that I do want to raise in the province of Quebec, which is sort of Quebec specific, is for the last 2 years, there's been a requirement when you register the company in the province of Quebec to actually divulge whether or not there exists a shareholders agreement. So that's sort of something that not everybody likes to do, because then theoretically down the road, a creditor, the tax department, a banker may want to see that shareholders agreement, but it's something that you do have to divulge.
Well, in British Columbia, we don't have a disclosure requirement like that. But when I meet with clients, I often go more fundamental. I explain to them it's much like getting into a relationship, and one of the first things you need to do at the beginning of the relationship is figure out how you're going to get out of the relationship. So it's actually planning for the divorce before you've even gotten started. And I've been so blunt as to say to clients, I think you'd rather talk to me about this now as opposed to dealing with this later and me telling you I told you so. So if you do nothing in a shareholders agreement but provide for a dispute resolution mechanism, such as what's called a shotgun provision, so that at the end of the day, only one, if presuming there's only two partners or two corporate shareholders in this entity, at least someone's going to end up with the business, and here's how the rules work. And that's very fundamental, and it's just part of good business management. But I do share Michael's view is that more than half the time it just doesn't get done. You'll actually draft the document and it just gets shelved because everybody's happy. But it's just that reminder. Again, I don't want to have to be the lawyer that told you so.
Great, thank you both. The other possible structure is a joint venture, and joint ventures can take different shapes. We're working with a European client now to do a joint venture, and it's basically two shareholders of the same company. The other structures we've talked about can also be used, limited partnerships, for example. So that's often a custom tailored structure depending on what the parties want to accomplish and how they want to accomplish it. Another common structure or arrangement is franchising. So franchising is basically that concept when one company creates a business model and then allows other companies, the franchisees, to use it and to use that in the business function. The obvious example we encounter probably every day are fast food restaurants. In the past, in Ontario, there's been concern that there's been a great imbalance between the big franchisors, that's like the McDonald's or Tim Hortons of the world, and the small business owner who's actually running the coffee shop or the restaurant. And there's been an attempt to try and address that imbalance with a special franchise act, which among other things provides some protections for the franchisees. One important early step is a disclosure statement provided by the franchisor with a lot of detail as to the relationship. In practice, we find that the imbalance continues, as you might expect, and some of these documents, like a disclosure statement, are so lengthy and so detailed that they're almost still overwhelming for the actual franchisee. So although there is a structure and it's probably better than it was, it doesn't quite correct the imbalance that exists just by the nature of scale and business between a franchisor and a franchisee. Mark or Morris, did you want to comment about franchise law in Quebec or BC?
Well, go ahead, Morris.
Sorry, so I'll speak briefly to Quebec. Quebec continues to be sort of an interesting area for franchisors to start their businesses because we, unlike Ontario and I believe 6 of the other Canadian provinces, don't have any specific franchise legislation. We typically, as Mike said, there is an imbalance between contracting parties, between franchisors and franchisees, and that's really regulated by our civil code, which provides for a general obligation of good faith between parties when they are co-contracting parties. So it's incumbent upon the franchisor to act in good faith, to provide the disclosure schedules, which Mike referred to, the operating manuals, etc., and to explain exactly what it is the franchisee is getting into. But other than that, and other than the language issue, because we have so many French-speaking people in Quebec, oftentimes the franchisors' disclosure material or operating manuals need to be translated into French, which is obviously a cost. Quebec seems to still be a franchise or friendly jurisdiction.
In BC, it's a similar thing that Michael's described. Just in 2017, did we adopt the Franchise Act, and the disclosure requirement in terms of the disclosure document, it's very new. Companies are learning to comply with it, but perhaps the strongest tool that goes back to the franchisee, if there's not strict compliance with the requirements of the legislation, it now creates a rescission right. So like many consumer-oriented laws for a time period, if the franchisor has not complied with all of the requirements of the Franchise Act, the franchisee has an ability to rescind. So that's quite an additional tool in the toolbox for a franchisee here in British Columbia.
So the alternative to creating a business, of course, is to buying one. And the next part of our presentation focuses on buying an existing business. It's exciting to work on mergers and acquisitions deals, and there's a real, I think, rush in for all the participants in reaching the finish line and accomplishing something. There's usually tight deadlines. There's pressure. There's sometimes different personalities. It's a very dynamic and fast-paced environment. But I want to start off by observing that, and I don't mean to be pessimistic about deals generally, but a lot of M&A deals don't actually succeed in their original objectives. I think the reason why they often fail is because normally disciplined business people become carried away with an assumption or an expectation that doesn't actually exist at the end of after the deal. So it's so important on the buying side to be constantly testing assumptions and expectations, because too often we can go forward in these transactions expecting a result that doesn't actually occur. And I think that's why a lot of M&A deals fail. I like to think of 3 key elements: planning, people, and process. Planning a deal is as important as any other factor. The people, the dynamic that exists between personalities, and how to deal with those. It will always be different in every deal. And the process, the way that the parties work together to resolve differences or deal with issues. And also, it's important for a buyer to always be ready to walk away. And that can be very difficult, especially as the deal advances and gets closer to closing. There's an investment, there's a commitment, there's an expectation. But sometimes there are signs that this is not going to end up well. And the best contracts, the best legal agreements can't protect a buyer from a situation where there's a bad actor or someone who is not being entirely forthright or honest in their dealings. So that's not necessarily the majority of deals, but I think that's always important for a buyer to keep in mind. Critical question at the outset is whether the buyer is going to buy assets or shares. Sellers typically want to sell shares. There's an advantage in their capital gains tax treatment. Buyers typically like to pick and choose the best assets and exclude liabilities. If they're buying assets, they don't need to take all of the obligations of the company, all the history and baggage, whatever that might be. And another issue that comes up on asset purchases and why it appeals more to buyers is because there can be a fuller discussion about what to do with employees. Under our employment law, where an employee has long service, especially senior employees, if they don't have a written contract, they can be entitled to a significant amount of notice on termination. So if the buyer's unsure about how to staff the new business once it's acquired, it may be reluctant to take on obligations, historic obligations of the company to a workforce, especially if it's a large workforce. And once those initial decisions are made, they're usually expressed in a letter of intent, or at least a non-disclosure agreement that allows the buyer to begin to receive information, confidential information from the seller. And a typical letter of intent will deal with price and payment terms, but also exclusivity, that the parties are going to work together for a fixed period of time to try and make a deal, and to deal with other features, conditions, for example, consents of landlords to the assignment of leases, or those sorts of issues. I just wondered if Morris or Mark, if you have any comments about those initial stages of an M&A transaction.
No, I would say that I think you've hit the nail on the head. The most important point, I think, is planning the deal, and certainly I look to sitting down with my clients well in advance of their going to market, because as you know, certainly if you're hoping to sell shares and take advantage of capital gains exemption, you've got to have your proper planning in place for at least 2 years prior to the sale taking place. For example, if you were to put the shares in a trust and multiply the capital gains exemption, you've got to be set up and ready to go. So that planning process is critical, and certainly something that you sort of I advise. I try to stay in touch with my clients, especially those that I feel may be ripe to be sold well in advance of the process.
Yeah, and I'd reiterate that point. In fact, what we're seeing more and more of in larger transactions is the role of an advisor, a special financial advisor on the transaction, who may have already been working with the company for a period of, say, as short as a few months or maybe as long as a year. And it's simply this concept: is this business ready to be sold? And you do need to get organized. You do need to get your material contracts in shape. You do need to know everything you thought you knew about your employees. You do need to know what your intellectual property looks like. And I believe Michael's going to touch on this when we get into the due diligence. But one of the things, and I'll come back to my theme about the tail, or the tax tail wagging the dog, that's a big theme. It'll be a theme throughout the transaction. As Morris has just described, there will be emphasis on trying to get the capital gains for the vendor. From the purchaser side, you will be looking to bump up the cost base of these assets. And what I'm seeing more and more in transactions is the tax advisors have gone crazy, and we're doing more and more of these hybrid sales, where there's an initial transfer of assets and then a transfer of both. So we're doing both a share and an asset deal to maximize the tax treatment on both sides of the fence.
Thank you. Just turning again to the due diligence stage, as Mark mentioned, I think really for the buyer, the due diligence never stops. Often there's a stage where there is a good deal of disclosure, and it's often financial disclosure, of course, also dealing with employment issues. And as Morris points out, on the sell side, there's a great impression that a seller can make by having an organized, thoughtful disclosure, as opposed to disclosing documents in a haphazard way, some complete, some not complete. That kind of haphazard disclosure diminishes the, I would say, business respect sometimes that a buyer will have for a seller. Whereas if a seller is organized and thoughtfully planned the disclosure and has a comprehensive package to deliver at the outset, that certainly makes the buyer think that the seller is well organized, well-run business. So it's important. I remember working on a deal in which a client had some environmental issues that it hadn't been as vigilant about as it should have been, and it had to because the buyer insisted on some greater disclosure and greater monitoring. And ultimately, the buyer's representative said, "Now I think you're an informed seller." And I won't forget that phrase because, of course, the seller thought it knew its business from the start. But from the buyer's perspective, the seller had been a bit too casual about some of these important issues. So it's very important to present well and to have some substance to give to reinforce the good business impression when you're disclosing information. So due diligence never really stops. And I think one thing that's very important in my experience in the due diligence stage is to test not just the data, but also assess the people. It's important not just to focus on numbers and projections, but also to think, what is the culture of this business? What is the business history? What is the outlook and the manner of doing business of the owners and the senior executives? That's going beyond the scope of a usual legal due diligence, but it really matters for business people because it's going to influence greatly the success. Throughout the due diligence process, we've found that, as I said before, process matters. So we often, when we're acting on an M&A deal, have scheduled regular calls with the other side, regular calls with our client's team to make sure that we're tracking the issues and getting the information that's required in a timely way. And as the due diligence progresses, there's usually, as I think Mark touched on, if it's an asset sale, there's usually a discussion about how the price is going to be allocated among the assets. And there's certain advantages from either side of the table as to how those allocations are done. And ultimately, a compromise is reached, and the parties agree on a joint view of how to allocate the price. As the due diligence process proceeds, the answers, the results inform the drafting of the closing documents. So if issues are uncovered, whether it's an environmental issue or an employment issue or litigation or product liability claim, that's informing and guiding the drafting of the documents. And at the same time, those documents would also address issues from conditions, whether it's getting consent from a landlord or assignments of key contracts that are uncovered in the due diligence stage. Mark or Morris, do you have any more comments about the due diligence process from your perspectives?
I was just going to simply state a little while ago that, it sort of sounds as though we're putting all of the onus on the sellers council or the sellers, and it's important to also note that it's important. Like, I enjoy dealing with a sophisticated buyer's council when I'm on the sell side, because it's imperative that buyer, start the process off after the execution of a letter of intent or an offer to provide a comprehensive due diligence request list so that we can populate the data room or provide the documentation that the purchasers are asking for in a prompt and efficient manner. And I think that goes a long way towards moving the transaction to completion, as opposed to sort of haphazardly getting requests as due diligence proceeds. One issue that I found is if that's the case, buyer may get tired, vendor may get tired, and then it leads to deal fatigue, which isn't good for anybody.
No.
Yeah, and that's where we see the more and more use of electronic data rooms for that exact purpose. Where I touched on an advisor. Well, many times good advisors have already started to load that room even before their letter of intent's done, and there's been any disclosure of any kind. So it is very important, because there's nothing worse than, as Michael says, you have these weekly meetings or more, and they keep asking for the same things, and it hasn't been put into the data room, or that information hasn't been produced, or nobody's followed up on it. And that does get very frustrating in the process.
Thank you both. So once the documents are drafted, of course, then there's usually a closing, and there are often post-closing issues, whether it has to do with payments over time or some condition to be satisfied. And one of the trends we see a lot of now are earnouts, which are basically provisions in the agreement that the buyer will pay more if the business meets certain targets, usually revenue targets in the first year, second year after closing. And it's a way of, for the buyer, reducing its risk on the success of the business. Of course, the seller might be worried that having transferred the control of the business, it doesn't have as much say or influence in how it performs afterwards. But that's often a discussion point between the parties. So if the business is started or if it's bought, there are registrations required in Canada. And one of the most important ones that we've touched on a little bit is income tax and the Canada Revenue Agency. When a company is incorporated, our government in a very helpful way creates a tax account. I'm joking, of course, but and then companies can also, a business number, which is basically the income tax account for the company. And in addition, companies can apply for harmonized sales tax, which we'll talk about, goods and services tax, other accounts that relate to tax. Corporations that are resident in Canada are required to pay tax, to file a tax return and to pay income tax. A resident corporation is a company that's incorporated or carries on business here or has its central management and control in Canada. Sometimes there are issues with when there's a parent and subsidiary arrangement. There's sometimes issues with double taxation. Those can be addressed with tax treaties between Canada and the country where the non-resident company is from. Companies are taxed with at a federal corporate tax rate and also provincial tax rate. In Ontario, the combined rate is about 26.5%. Morris and Mark, do you want to talk about the layers of corporate tax in your provinces?
Yeah, so it's similar in the province of Quebec in terms of the corporate tax. I guess the only thing I would add is it's mentioned on the slide that in Quebec we have both a federal goods and services tax of 5% and a provincial goods and services tax of 9.5%.
And in BC, we have a similar, we don't have an HST, we have a provincial sales tax, which runs at 7%. And of course, GST runs at 5%. For registration purposes, again, I mentioned in BC, there's been a lot of work done over maybe the past 10 years in creating more electronic systems. And one of the things available to new businesses starting, they literally have something called a one-stop registry, where all of these different offices that a new business needs to register for can go and apply for each of these offices, including things like workers' compensation. We've got a reference to employers' health tax. That's something new in British Columbia, that if you are over a certain number in your payroll, you have to pay an additional tax simply because of the number of employees that you have. But all of these things are more and more being made more and more available electronically.
So just to talk about some of the points that Mark mentioned and Morris as well. So we do have a goods and services tax, which is a value-added tax in Canada. And in Ontario, the tax, our provincial sales tax and the GST are combined in what we call the harmonized sales tax, which is 13%. There are also, when we talk about taxes or remittances, there are also what we call source deductions, which are a portion of salaries that are remitted by the employer to the federal government on account of our national unemployment insurance scheme and also the Canada Pension Plan. One thing that's really important for employers is to avoid situations where they should be remitting those amounts but aren't because of a misclassification of a worker. A lot of people in some industries want to be classified as independent contractors. That would mean that they're essentially in business for themselves and the employer's not to make deductions, and the contractor can make business deductions for tax purposes. Problem arises when the individual is not truly an independent contractor and the employer should have remitted for Canada Pension Plan or employment insurance and fail to do so, and consequently can be exposed to penalties and interest. So just to be watchful regarding source deductions. We're trying to reserve some time for questions and answers, so I'm going to move a little quickly through some of these other points, and we're, as I said, looking forward to having more questions that we can address in the remainder of the presentation. With regard to municipal regulations, different cities have different licenses for certain kinds of businesses in Ontario. We also have property taxes, realty taxes, which are based on the fair market value of the properties. In Ontario, there's also a land transfer tax whenever a tax is levied on the price of real estate when it's sold. And there's also a surcharge in the city of Toronto, as well as a non-resident speculation tax. So there's some layers of tax that are involved in the transfer of land. With regard to bylaw compliance, often cities and towns have regulations on what kind of use can be made of properties in different locations. And it's important if you're planning or involved in planning for the use of a property, whether it's a construction or a renovation or some new use, or even the acquisition of the property, that you check to see that your intended use would comply with municipal zoning. Mark and Morris, do you want to comment on any municipal regulations or any issues that come up for businesses in Quebec or British Columbia?
No, I mean, we have a similar system in Quebec. Our land transfer tax is called mutations tax, but typically when you sell a piece of land, there is a transfer tax levied. And as you say, municipalities sort of chime in depending on the type of business that is entering into their area of So, for example, I think on one of the slides we mentioned that cannabis is now a business that is thriving in Canada, and the municipalities have a say in terms of what cannabis companies or licensed producers, for example, may operate in their particular municipality. So that's I think similar throughout the country and throughout the municipalities in Canada.
Right, and we have a similar experience here in BC, and I think it's just safe to say is that there will be somebody you will need to answer to somebody for everything. And it will go right down to signage, it will go down to health and safety issues, it will go down to whether the elevator in your building's been inspected properly. So you just need to be mindful of those, and your particular use in your business will largely dictate what kind of compliance issues you're going to have.
Thank you both. The next issue, we're going to pause. We're not going to make our way through all of this slide because, as I said, we want to reserve time for some questions. We're getting some great questions from participants. Thank you. I did want to touch briefly on employment law. It's often a tripping point, I think, for people who are starting businesses in Canada. And one of the reasons, certainly from Americans coming to Canada, or sometimes other jurisdictions as well, is that this is not an at-will employment jurisdiction. In other words, if an employee is terminated, unless there's proof of serious misconduct, which is often hard to prove, the employee is entitled to a notice of termination or payment instead of notice. And that's a key distinction. We do encourage businesses to have written employment contracts, and it matters that they have those signed before the person starts work, when the employee receives value for signing. And there are lots of issues to cover with those. Termination is one of them. Also confidentiality. In some jurisdictions, employees can be restrained from competing. That's generally not enforceable in Ontario. An employee can be restrained from soliciting customers. That's important if someone's in a sales position, for example. So those are some key issues that are touched on in an employment agreement. But as I said, it's very important to understand that there are common law obligations for an employer, especially around termination, and it's important to try and address those, and they can be excluded to some extent in a written employment agreement. So we really emphasize the importance of that for businesses. Morris or Mark, do you want to talk about just generally, I know it's a broad topic, but just some general thoughts on employment law for businesses.
So I'll just quickly touch on Quebec. Quebec legislation is pro-employee and offers employees extensive recourses and remedies in the event that they are terminated. You talk about terminating employees at will. We have sort of a just cause definition. So if an employee has been with an employer for more than 2 years, our Quebec Labor Code affords the employee the right to challenge termination, stating that the person has not been terminated for just cause. And that's a powerful tool for the employee because the employee can apply to an administrative tribunal, doesn't have to have an attorney, and can actually ask for reinstatement. And that leads the employer to necessarily offer more than the minimum statutory notice in order to terminate the employee. So a lot of these employees will use the Labor Standards Act to, not going to say extort, but receive more than what typically they would be entitled to under our Quebec labor legislation.
And in British Columbia, it's very similar as to what both Michael and Morris have described. We do have not only the common law aspects in terms of effectively an employer in Canada or in British Columbia can terminate an employee at any time. The only issue is whether they've been given reasonable notice. And the just cause provision here would be a basis for not giving any notice. But we could otherwise terminate any employee, any length of term of service, provided you gave reasonable notice. And there's quite a range in what that might be, and you would assess it based on responsibilities. But the other thing to also remember, overlaced on top of that, is a whole statutory regime. And in British Columbia, we have employment standards, which set minimum requirements for things like hours of work, overtime, vacation time. We also have the Human Rights Code here in British Columbia, which is to ensure that you're not creating an environment that you might be discriminating on the basis of a whole laundry list. It could be on the basis of sex, it could be on religion, it could be any number of items listed there. In addition to that, we do have workers' compensation legislation, which also touches on workplace harassment and an environment in the workplace. So you have both the common law at work and then again, a whole statutory regime that needs to be complied with.
Thank you both. That is a big topic, so we'll pause there. And there's certainly more to talk about on employment law. It could be a seminar in itself, but those are, I think, some great points to guide at least an overview. At this point, I thought we would pause and answer some of the questions that we're receiving, and I want to thank the participants for posing them. The first question I want to turn to is, and this touches on employment law, so it's a nice connection with our discussion of just a moment ago. How does the employment law impact company structures in Canada? Are there any requirements, legal requirements, to have employees represented in decision-making of the company? So I know that in some European countries, there is a requirement to have employee representatives. In Ontario, there's no such, on a board, for example, there's no such requirement in Ontario. There are specific legislative requirements, for example, occupational health and safety. If a workplace is over a certain number of employees, there does need to be a joint committee, workers' representatives and management representatives, to deal with occupational health and safety. But beyond that very specific role, there isn't a general obligation to involve employees in the broader business decision making. Of course, good management would certainly encourage good communication, good discussions, but not as a legal requirement. Morris or Mark, do you have any additional comments on employee involvement in decision making?
No, I would say that, it's the situation in Quebec is similar to that in Ontario. The only other thing I can think of where the employees are perhaps more involved in decision making. Again, it's kind of funny, but it's driven by language laws. So in Quebec, if your business has more than 50 employees, our Quebec language office, which is an administrative office, requires that the company have a franchisation program. So ensuring that business is conducted primarily in French, that inter-office memos are in French, and employees participate in that committee and in the development of that type of policy.
British Columbia is exactly the same, except for we don't have any of the language requirements, and I can't think of any specific requirements for employee participation in the management decisions of the company. That typically they're not there. If they are there contractually, and it's because the employers decided to create, either a user group or an advisory committee, or to give employees an actual board seat or an advisory role to the board, but they're not mandated by the law.
Here's another question, and this is a very good practical question. How important is it for small, medium enterprises to hire a good lawyer or accountant in the first year of business when the costs are high and the sales are low? I would say that it's very important to start any business on a good footing, and advisors can help. And the issues we talk about are often complex, and they're often different varieties, but I think that good practical advice on something that is appropriately scaled, appropriately tailored for the size and stage of the business is great value. If we want to return to the idea of a shareholders agreement, or getting an employee to sign an agreement before the person's hired, the cost involved in that and doing that well will certainly be rewarded in the long term. If the business is sold, for example, or there's a disagreement or something like that, it's so much easier to get these things right in the first place than try and deal with them later. And it's in fact much more expensive to deal with problems after the fact. So I think good practical advice at a reasonable cost is invaluable. I'm a lawyer, so that's obviously my perspective, but Mark and Morris, do you want to share your thoughts on that?
Yeah, I totally agree. I mean, typically when we take on a new client, I know Mike and Mark probably work the same way. We understand that it's expensive to engage counsel, but it's important, and I think you're going to save a lot of money at the end of the day if you avoid the issues and they're identified at the outset with good legal counsel.
And I'd confirm that comment. I've actually had a circumstance where the business party came in. They weren't mine originally, but when they came in because they had a problem, and they had one business, an operating business, and another company that owned the land, and for whatever reasons, they only did a shareholders agreement concerning the operating business and never did it during the land. So from a lawyer's perspective, particularly my litigators, it was a wonderful foul because it went on forever. Because they said, well, we really intended to do it that way. Well, intention isn't good enough. And had they spent the time and finished the second agreement, they would have had a lot less grief. It would have been quite clear how they were to part company. And so again, lesson learned. And I didn't quite get to say I told you so, but I think that is the lesson. If you spend that money up front, it is well invested.
Okay, well, I think we have time for one more question. This one is, if an international client wishes to buy a business in Canada, what difficulties would it have if the client does not have Canadian resident status? So we've acted for a lot of businesses from outside of Canada coming here to buy a Canadian business. There's a lot of inbound investment in Canada. The difficulties are not steep. Certainly there's a general orientation as to the legal landscape and understanding many of the issues we've just talked about in the seminar. the Canadian residency status, there is a reporting requirement when non-residents buy a Canadian business, but it's simply a reporting, and unless it's a very large transaction, there's usually no review of the transaction, or if it falls into a special category dealing with certain kinds of businesses, or if there's a competition issue as to whether this is going to lessen competition. But on the whole, there aren't really major difficulties for a foreign company buying a Canadian business that wouldn't also apply to a Canadian company if it were buying a business. Yeah, I think at that point we're out of time, and I want to thank everybody for participating. It's been a pleasure chatting with you over this webinar, and thank you for the great questions. I want to say a special thank you to the ACCA for hosting us today, and it's been great to connect with the local team here and over the webinar with so many members. Also, a big thank you to Morris Wimmer and Mark Wong for their participation and sharing their experiences and insights. My name is Mike Henry, and we have on the last slide our contact information. So if anyone has further questions, feel free to reach out to any of us, and we'll be happy to chat further. Thank you.
Great. Well, thank you very much, Michael, Mark, and Morris. That was a fantastic presentation. And thanks to all of those who joined us today. In a moment, you'll be prompted to answer a survey. If you could kindly take a moment to fill that out, it will help inform our future webinars, and we would really appreciate that. Thanks, and have a great afternoon.